Is this a market crash or time to buy? We've put together some data that I think will help answer that question. But first, we must talk about the inflation data and also a very interesting market correlation. First, inflation. Wholesale prices are declining. Today, it was released, the PPI, Producer Price Index, on a year over year basis, 3.2%. That's a decline, going back several months actually. This is a good sign. Core PPI, excluding food and energy, that's down to 3.4%. That's also a 3 month low. This follows yesterday's softening consumer price index number. This is good news. But maybe it's not enough. Profit margins are still being squeezed. When wholesale prices exceed consumer prices, profit margins are compressed. Here we can see the consumer price index minus the producer price index, both on a year over year basis. And we can see we're 5 months in negative territory. Now, true, this month it was a tick up in the right direction, but producer prices, meaning the price for raw materials, is still rising at a rate faster than the retailers can charge the consumers. The profit margins are being squeezed. Here's another way to look at it. The blue bars show PPI, Producer Price Index, the yellow, Consumer Price Index. Fifth consecutive month, but third month with a real divergence between the two. And this is not a good sign. Think of the earnings season coming up. Those profit margins, they may not look so good. Now, the market has decided that the Fed will cut rates in June. We spoke about this yesterday, but it's even more of a conclusive answer now. In yellow, S&P 500. In blue, that is a probability of no interest rate change in June, and that is declining. Actually, both are declining together. What this means is as stocks go down, the probability the Fed won't cut rates, that's also going down. Rate cuts are getting closer. Here we can see these are the probabilities in yellow of no change. And just in the past day, the probability in June that the Fed would not cut rates dropped from 23 to 11%. The probability of a half a point cut, well, that also dropped from 19 to 17%. Well, so wait, they're not going to cut or they're not going to cut by half. It's the quarter point cut in blue, 58 to 72% in one day. That's actually a pretty significant increase. And what this is telling us is the market is deciding that number one, June is an interest rate cut, but number two, it's a cut by a quarter, not more and not less. Now, the bonds, they continue to be more resilient than stocks. We also mentioned this yesterday. Again, in yellow, S&P 500. In blue, that's a 10-year U.S. Treasury. And what you can see is that as stocks decline, well, the bond market has stopped declining. The yields have kind of found a resting place here between the 420 to 430 level. By the way, does this chart look familiar? If it does, there's a good reason for that. These are two different markets, but they look very similar. On the left, that is the probability of no interest rate change in June. We're talking about the blue bars, the yellow S&P 500. On the right, that's the 10-year US Treasury. Really kind of not odd, it's expected, but very unusual that the charts look absolutely so similar. What is this telling us? It's telling us that as stocks go down, the probability the Fed won't cut rates. After all, we have a weak jobs market and inflation is ticking down. So the Fed's moving closer to an interest rate cut. But what this is also telling us, a 10-year bond tells us the prospects of future economic growth, that is also starting to wane. And they're moving pretty much in lockstep. In fact, yesterday, take a look at the spike, followed by today's sell-off on both sides. The June contract on the left, 10-year U.S. Treasury on the right. Now, here's a question that we all want to talk about. What's going on with the stock market? Well, this is the S&P 500, not now, 2007. It hit an all-time high, October 11th. Now, there's a very important reason because I think we're following the same dynamic as what we saw in 2007. That's why we're talking about it. So again, October 11th, 07, S&P 500 hits all-time high. Now, let's consider the leadership at that time. Those are home builders and banks, etc. Well, Citibank hit its all-time high December 26th of '06, but the S&P 500 did not hit its all-time high until October 11th, almost a year later. Notice how much Citibank sold off as the general index was still going up. The foundation, meaning the leaders, the strength in the market, the reason why we had a bull market, in part was due to the banks. That had already started to decay. Think of like a house with a decaying, foundation. Eventually, the rest of the house collapses, and that's exactly what we saw here. Here's a better example. Williams Sonoma. This is a furniture company. Why are we talking about furniture? Good reason. I'll tell you in just a second. Williams Sonoma hit its all-time high January 11th, '06. Well, the S&P 500 didn't hit its high until October 11th next year. Look how much Williams Sonoma declined. How about Lennar, the home builder? They were right in the center of the 2007 bull market. They hit their all-time high July 28th of 2005. In fact, the stock was literally creamed before the S&P 500 finished going up. So if we were just watching the index passively without looking at the leadership and the behavior of the leadership, we would have been unaware that the foundation was crumbling underneath. The market leaders support multiple industries. It's very important. It's not just that Lennar was strong or Citibank, but they were supporting their own industries. For example, in 2007, these were just some of the leaders, the banks like Citi, Goldman, JP Morgan, Wells Fargo. On the home builder side, Lennar, Toll, many others. Well, there are complementary industries to the banks like credit cards and insurance, Visa, MasterCard, American Express, MetLife, and Prudential. There are also complementary industries to the housing market like furniture and home improvement and construction, Williams Sonoma, La-Z-Boy, Wayfair, Home Depot, Lowe's, Caterpillar, and Deere. When the leaders fade, the market becomes vulnerable to news and uncertainty. Again, when we go back to the analogy of the house with a crumbling foundation, when the foundation's not strong, a strong wind could blow everything over. Well, now, present date, S&P 500 hit its all-time high Feb 19th. Here's one of the leaders, Tesla, all-time high December 18th. Take a look to see how much Tesla went down while the S&P 500 was still chugging higher. How about Nvidia? That's one of the biggest stories of the year. All-time high, Jan 7th. This is how much it came down while the S&P 500 was still making new highs. So again, it's important to look at the indices to get a general idea of where the market's going to trend, but make note of the leadership and make note of the strength of the leadership. Without leadership, we don't have a strong foundation. See, here's my take. The current market sell-off is a sector rotation and not a crisis, at least not yet. One of the reasons is that I know we look at the leadership, the Teslas and Nvidias, and we see down 2, 3, 5, 10% a day. But overall, the market's not really going down very fast. At least a lot of the other stocks aren't. So it looks like the money's coming out of the leadership, out of the Teslas and Amazons, but it's not coming out of the entire market. How do we know also? Take a look at the VIX, the volatility index. We did a video the other day. We spoke about the different levels in which we really need to start to worry about the VIX. Right now it's at 25. And what we can see, it's not really an out of this world type of level. 25 to 30 means the market can feel volatile. If you want very smooth, quiet bull markets, we need to look for a VIX around 15, maximum maybe 20. But 25 to 30, it's going to be a bumpy road, which is what we're feeling now. And if you take out the Teslas and Nvidias, it's bumpy, but it's not awful, but it is bumpy. So caution. With that said, without leadership, the market is left vulnerable to news, daily news, uncertainty, possible black swan events, maybe something else. So watch the VIX. If we stay below 30, we're at 25 right now, it tells us we're on a bumpy road, but not a huge reason for concern. But if we really start to see an acceleration to the downside, VIX readings in excess of 30, even approaching 40, I think that changes things. We hope this has been helpful. We look forward to seeing you back soon.